What's good, YouTube? It's your boy CJ, and I'm back with another video. And in today's video, we're going to be going over some basic vocabulary and knowledge that you need to know for day trading. Now, I'm not going to go over every single little like word in the whole glossary of trading. If you want to, you can look that up. But I will give you things that you're going to frequently hear um, from traders, including myself, if you're watching our videos on how to trade and things of that nature. So it's gonna be like a quick little video. Shouldn't be any longer than like probably like 10 minutes, 15 minutes. But it's just gonna be going over some basic knowledge and stuff like that. So yeah, and by the way, like I know that I have definitions and stuff on the screen. You could read them. I'll read some of them, but like really just listen to what I'm telling you and like also take notes if you need to, because I know that some of this stuff I'll probably go a little bit off script just off of like knowing things that I just be talking about. So like I said, just make sure you get your pen and notepad and just take any notes that you need to take. And yeah, let's get to it. So first off, you have three types of traders. So um so you have your scalpers, you have your intraday traders, and you have your swing traders. Okay, so when it comes to scalping, as you can see, it says that scalpers will hold their trades for seconds to minutes. I would say really like some scalpers even hold it a little bit longer. Like I would say they're usually not in the market longer than like an hour or so. And I'd say for the most part, when you guys like see traders on social media and stuff like that, a lot of them are scalpers. Um, and the reason why I say that is because I see like a lot of times like people will have clips where they're trading on the 1 minute or maybe the 5 minute, and they're only staying in a trade for like small price movements. So when I say like a small price movement, it might just be like 10 to like 50 pips maybe, or sometimes like when price has like a huge spike down, they'll just like close out the trade like just like that. They don't want to see their trade really go back towards their area of entry, or like um or go back into drawdown before going back into profit. Like a lot of time it's like as soon as they see profit, boom, they're taking it out. Or um after they're in a trade for a few minutes, like I said, they're just out of the trade. Okay, now intraday, they're holding for minutes to hours. I would say I'm like, me personally, I'm a hybrid between like a scalper and intraday trader, because there are times where I hold my trades for hours at a time. But for the most part, I prefer to be out of the market within the session that I'm trading in. And just depending on how the day goes, how much volatility is in the market, I usually tend to get out of the market after like mm, yeah, I would say I'm more towards like an intraday, but again, sometimes I do scalp. Like I'll be in the trade on average. I think like actually I have my journal. I could tell you exactly what my average is for my average hold time is 21 minutes. But as you can see, like I have 10, 15, 50, like an hour. Sometimes like I'm in trades for like 2 hours every once in a while. But yeah, so on average I'm holding a trade for about 20 minutes. So I would say I'm pretty much I'm more of a scalper, but I do trade intraday, I guess, because I do look at the chart for a couple hours and at times, and sometimes I do hold my trades for the day. Um, if I feel like price can like continue in that direction for a couple hours, and I would just want to squeeze out what I can. And then the swing trader. These traders are holding trades for days to weeks. And these are pretty much positions. You need to have a little bit more capital in general. Um, Especially if you're trading futures, there is like a certain requirement for the amount of money that you need to hold trades as a swing trader. And swing trading is definitely good. It's just gonna take you a while to see your profits and things like that. You'll see bigger fluctuations, and then you just won't see, like, you won't necessarily see the money as quick, but you can see the money pretty fast. Like you're again, like you might get in the trade on Monday and you might close it on Wednesday, or you might get in a trade on Thursday, hold it over the weekend, and then get out on the next Tuesday. So that's a swing trader. um Whatever type of way you trade does not affect how much money you make. The amount of money that you make can be the same if you're a scalper, and it could be the same if you're a swing trader. It just depends on the risk management, and it depends on the amount of pips that you're catching or points. So and that's another thing. You should write this down if you don't know what it is. So a point and a pip is all that is just a measurement that we use to identify pretty much how much we're able to make on a specific price movement. So like if I for example, um forex, it's called the lot size, and in futures it's called contract sizes. But if I take like a standard lot or one mini contract, same thing, and I hold a trade for, let's say, 50 pips or 50 points, that would be worth $500. Okay, so and then there's also like your micro contracts, which is the same thing as like a I forgot what it's called on forex. I haven't traded forex in a long time, but it's basically like a smaller lot size. You'd like point one would be the same as like um one micro contract, I'm pretty sure. Okay, so next we're going to talk about trading sessions. Trading sessions, now these times I have, they're accurate, but they're not like fully accurate, just because these sessions do overlap into each other. But generally speaking, um when you're trading Asian session tends to be a little bit slower. You usually trade it from 6 p.m. to well, it opens up at around 6 p.m. and the market closes at 3. Well, again, technically it doesn't close because it overlaps into London session, but London session will start at 3 a.m. and then go on until 8, and then it overlaps into New York session. New York session it goes all the way till, it's technically 5, but really 4 o'clock. So again, like these sessions do overlap. So like these are just like the general times. Again, Asian is usually a little bit less volatile. London session is pretty volatile. I've only traded London session probably like a handful of times in my like trading career. And then New York session is pretty volatile. New York session is what I trade for the most part. Every once in a while, I might dip in the Asian session. But yeah, for the most part, I'm trading New York session. And if you're on the East Coast, this is probably the best one for you, as long as you well, it depends on your job as well. So if you work around this time, then maybe you should go into Asian session. Or if you're really like really serious about it, you've been making money or whatever the case may be, and you're willing to take the sacrifice, which is what I did, and work a third shift job or a second shift job in order to like basically fulfill your trading dreams, then you could trade New York session at that point. Like you just have to get a different job, you know what I mean? So yeah. And so volume and volatility. So I'm gonna go onto the chart for this, but basically volume and volatility, they go hand in hand. All it is just you're gonna see bigger candlesticks on the chart. So like if we go to the chart right here, so when you're getting into the market, right, you have a bunch of like huge like firms, companies, and like investors, and as well as like day traders and things like that putting money into the market. Okay, so on this chart right here, right, let me actually just zoom in because I don't know how it will look for you guys, but you guys see how like you have all of these smaller candlesticks, right? You have small candlesticks. They're wicking. These wicks right here and things, that shows that we do have some type of volatility because price is going up and down, right? But at this point right here on this candle, this big candle right here, this shows that we have a lot of volume and volatility because the market moved very fast and it spiked down. And this is a good candle too. This right here is this is an opening of a candle. Like this you're not trading. You're most likely not trading. This was like this was an opening candle of Asian session on Wednesday. So don't worry about this, but this does also show like a lot of volatility in the market. This is the kind of stuff that you would love to be in if you're on the right side of the market, but if you're on the wrong side of the market, you're fried. But anyways, so again, as I was saying, so on this candle right here, right at 3 a.m., there was a lot of volume that kicked into the market. So you had a bunch of investors and things like that putting their orders in here, selling, and price shot down, and then we came up a little bit. So this goes into like market structure. We came down, we came up, and then you had more sellers like saying nope, like you get this one buying candle, this one bullish candle, but sellers are like nope, like you're not going nowhere, like we're gonna keep on selling. More sell orders are in here, and then we just drop again. So that's what volume is, that's what volatility is. It's just basically like a lot of contracts, a lot of shares, a lot of whatever you want to call it in the market um are pretty much getting inputted into the market. Is that the right word? Input it? I don't know if that's even a word. But they're they're being put into the market, and whether it's a buy or sell, like you get these huge candlesticks um followed by like larger moves, versus having something like this, which you have a bunch of smaller candlesticks and a lot of consolidation, right? So consolidation, that just means we're in a sideways market, okay? And then if we're in a bullish market, then it would mean that we're getting um a lot of buy candles, and then but bearish would be like, and would be we're selling off. So like you see how we're creating structure to the downside, we're selling off, okay? That's bearish, okay? So yeah, so bullish and bearish. Matter of fact, we'll just go right back to the chart just because it's right there. Well, I'll talk about it first. So bullish, it just means that we're rising up. Bearish means that we're going down, and it's essentially the trend. They say the trend is your friend. You essentially want to follow the trend in most cases. So if we're looking on gold right now, we'll go to the 4-hour. We're looking at gold, as you can see, price is clearly going down. We are in a downtrend. So this is a bearish trend, okay? Now the red candlesticks that are going down, these indicate that they're bearish candlesticks. The green candlesticks indicate bullish candlesticks. But you don't have to really worry about that too much when we're in a downtrend. If we're in a downtrend, sure, you could take buys, but it's more ideal that you want to get into the sells in these areas, just because they're more likely to play out. You're more likely to get a better move, more money, longer, the ability to hold trades a little bit longer, okay? Now if we look on NASDAQ, we'll just look at like the overall trend. So the overall trend on the daily, where does it look like we're going? We're going up. So NASDAQ is the stock market, essentially. So the stock market has been going up for a long time, right? So overall, we're in a very bullish market as far as like daily, monthly, like weekly structure. But so this is a bullish market, okay? Like now if you were to like come over here and like look at what's going on currently, it does look a little bit like it could be bearish. But we are coming to a key level where you could see price reverse, but I mean I'm not buying this right now. So yeah, and which also reminds me, going back to how we were talking about the types of traders we have, right? So when we talk about this stuff, I want you guys to know that I have a separate investing account for investments, okay? So I might trade the NASDAQ and I might take sells one day, or I might even take sells for 3 days in a row. But on my actual account that I'm actually like investing in for the long run and I'm holding on, because we're in a bullish market, I dollar cost average. So that just means that whether we're here or whether we're down here, I'm just buying like every week I put, or every month or whatever you want to do, you put money in. But every time I'm pretty much buying, no matter where we're at. I'm just buying. I've been actually buying a lot since March. So yeah, okay. So but I will say, just understanding how charts look and stuff like that, and being able to read a chart does help you with investment opportunities, as far as like where you could get in, where the bottom of the market might be, although no one actually knows what the bottom is. You could definitely like find good entries and stuff like that. You don't gotta like get in at the wrong places. You could possibly wait a little bit or whatever. But again, if you're dollar cost averaging, don't worry about that. Time in the market is better than, or yeah, time in the market is better than like trying to guess where you're going. You know what I mean? Okay. Now, going over candlesticks. Candlesticks are, once again, these are your candlesticks. I'm not gonna go over candlesticks way too much in this video, but you have bullish candlesticks, you have bearish candlesticks. Each candlestick tells its own story. Okay, so you can basically, kind of in a way, create like a hypothesis of where you feel like price is gonna go based off of these candlesticks. Like if you get this huge bearish candlestick right here, right? That shows that we're bearish, right? So now all of a sudden I might be looking at sales just because this is such a strong bearish candle. You're not really expecting price to just shoot back up, right? You're expecting price to go down. So you might get some sells or whatever, okay? And the same thing with the buys. If you get like a huge bullish candlestick in a bullish market, you might want to start buying because it's like, okay, well, you may be going up from there, okay? And so when it comes to this, like you have the body of the candle, this is the body, and then you have the wicks. So the wicks are right here on the bottom and the top and the bottom right here. You have your wicks. So all that is just, again, you have the opening of the candle, the close of the candle. This means that price essentially started here, went up here, it started here, went down, went back up, and then it closed right here. Okay, so if you want to really like learn a little bit more about candlesticks, I would say go on YouTube, type in like Japanese candlesticks or understanding Japanese candlesticks. There's plenty of videos on it that could help you. I will say you don't have to worry like you don't need to know every single candlestick pattern or anything like that. Just understand market structure, understand price action, and that'll take you a very long way. Okay. Now, support and resistance. So again, I always say in all my videos, support and resistance is basically like a floor and a ceiling. So on the top, you have the ceiling. On the bottom, you have the floor, which is your support and your resistance. Okay. So like if you were to throw a basketball or throw a tennis ball on the floor, what is it going to do? It's going to bounce off of the floor, hit the ceiling. It's going to bounce off the ceiling and hit the floor, but it's not going to break through those levels. Okay. So obviously if we had a ball, like eventually it'll stop bouncing, right? But when it comes to trading, you're pretty much waiting for price to break out of those areas. So like let's say so these were candles, you're waiting for candlestick closures out of those areas. So if we were to go back to the chart again, let me show you. So let's see what's like a really good example. Okay, right here, back to where we were actually. So on gold, right, you have a resistance and you have a support right there. You could even throw your support right here if you want to. So you have support and resistance. Okay, so after creating the support and resistance, and you know what, even better, let me go here. This is a better example, I feel like, just so that you guys could really actually see it. Okay, so you're essentially just trying to like put price into like a little range, right? So you have your support, you have your resistance, right? So you can tell it's support, you can tell it's resistance by all of these wick rejections. So you have wick rejections all in here, and you have wick rejections all up here. Price is not breaking those levels, okay? Like it's struggling to break those levels. Once you get this candlestick closure right here, on this candle right here, this red candle, you get a strong bearish candle. So this is another thing, just talking about how we're saying the candlesticks tell a story. A strong bearish candlestick like this underneath the range, underneath this support, underneath this resistance, it shows that we're breaking out of that range, and it is indicating that we could possibly be selling. So you could take sales here, you could take sales on the retest right here, you could take sales pretty much after you get this candle, and then you would throw your stop loss pretty much wherever you want. I would say it should be like above here, or maybe above here, depending on your strategy. It could even be right here, like wherever you want to put your stop loss, wherever you want to manage your risk, that's where your stop loss will go. But yeah, you're waiting for candlestick closures above a support or a resistance in order to continue the direction that you want to go in. And again, the trend is your friend. So if you were to get a bullish candlestick in here, I would say be cautious of taking that breakout, because you could see we already have strong bearish indications, right? So price did this. Boom, chilled, boom. Now it's gonna retest, chill, boom. It might come up, boom. That's what price likes to do. It doesn't perfectly go like this, like how I always show you, but sometimes it'll like just chill, create a support, create a resistance, boom, chill, support, resistance, boom. So that's literally what we did right here. Okay. Stop loss and take profit. Okay, so your stop loss and take profit, and actually the next slide is also type of market order, so we'll go over both together. So your stop loss and take profit is just basically, if we could go right back to where I was. So if I were to take a sell right here, your stop loss would be like, let's say you put your stop loss here and you wanted to take profit right here. Okay, so a lot of people think about risk to reward ratios and things like that, so I'll put it at a 1-to-2 just for the example. So let's say that you got into your trade here, so you got into a sell, right here, right? Your stop loss is right here. Stop loss, and then your take profit is here. Okay, so you have your sell, your stop loss, your sell, your stop loss, and your take profit. So let's pretend that we got into this trade and we wanted to risk $100. This means that once you trigger the trade in, your money, like, don't worry about it at that point. Like, you entered the trade, you entered for a reason. You should know how much you're risking on this trade. So just like if you were sports betting or something like that, you know how much you're putting down on that bet. If you're gonna risk $100, you can risk the $100, right? It shouldn't be money that you're scared to lose. Okay, so if you trigger that sell entry in right here, and let's say right here you wanted minus $100, okay, this is where risk to reward comes in, because you're minus 100 right here, right? But if you were to go for a 1-to-2 risk to reward, which is right here, this means that you would be making $200 on your trade. And if it was a 1-to-3, like let's say it's a 1-to-3, you would be making $300 down here. And then like somewhere in here, it would be like $100, because it's a 1-to-1 risk to reward ratio. Okay, so that's how like risk to reward works. That's how stop loss and take profits work. As far as your actual stop loss and take profit, the reason why you want to have these in is because at least a stop loss, you should at least have your stop loss in, because it minimizes your risk. If price didn't just shoot down like this and it came up like this, then you would lose $100. But if price does this, you'd be making money. So right here, I want to say, so like let's say you did get into this trade, right? And we start coming down, Your TP is here. This is probably maybe like $130, right? And then we came back up, and then we went into drawdown a little bit, and now you're probably sitting at like minus like $30 or $20, something like that, right? Then we got the big move down, and then you hit your TPs, you $200, $300, whatever it was. Okay, that's kind of like how fluctuations work when it comes to trading and stuff like that. So there's that. Now let me talk about your limit orders and your market execution. By the way, this example right here would be technically a market execution, because if you were to just get in based off of the candle closure, you click the sell button, boom, and then depending on what broker you have, sometimes you could just drag it up, drag up a stop loss, drag down the TP, or you'll have to do what I'm going to talk about right now. So market execution, all you're doing is just clicking the button, buy or sell, wherever you feel like price is going to go, and then you put in your stop loss, which minimizes your risk. You basically know how much you want to risk, and then when you're ready to close the trade, you just click close the trade. Like it could, I don't, depending on the broker, again, it might be an X, it might say cancel orders, whatever it might be. You just click that, and then you're out of the trade. You get in, you get out with the click of a button. Okay. Now, when we talk about limit orders and limit stops, okay, or stop orders. So again, let's say that you wanted to let me put this in replay. Let's say you were like, okay, I'm not looking at the chart right now, but price is way down here, and I want to get an entry up here, but you're not looking at the charts, right? You would put a limit order. You would put a sell limit here, indicating that if price comes back to this level, you want to be triggered into a sell. So as soon as price hits that level, which it does on this candle, boom. Now all of a sudden you're triggered into a sell. So now from that point on, anything that goes down from there, so like if we tap this and start pushing down, we're automatically getting into profit, right? If we go up, we're gonna be in above that area, we're gonna be in a little bit of drawdown, right? And so then that's where you want to throw in your stop loss. So when it comes to limits, you want to have you want to just throw your stop loss there, throw your TP down here, whatever. So this would be your sell limit. And okay, before I explain this, I just want you guys to know futures is a little bit different from Forex. I can't really remember exactly how Forex was, but I know I was a little bit confused when I started transitioning to futures. But in the futures, as far as futures go, I'm not sure about like stock trading or anything like that. But as far as futures trading, if you have a sell limit, right, this indicates that you're in a sell currently. Like, so if your sell limits gets triggered right here, you're currently in a sell. You have to have a buy stop as your stop loss, and then you need to have a buy limit as your take profit. Okay, that's for futures. So if you're getting into a sell and you want to use a sell limit, a buy stop would be a stop loss for you, and a buy limit would be your take profit. And then the same thing the other way around. So if you were in buys, like let's say you wanted to get buys right here, hold on. Let's say you wanted to get buys down here, right? So if price was up here and you just wanted to get buys right here, so boom, you wanted to get buys right here, but you're still bearish, but you wanted to get buys here, and you wanted your stop loss somewhere down here, your take profit right here. You would use a buy limit, okay? Buy limit, and then if your TP is up here, it would be a sell limit, and then that's your TP. Your stop loss would have had to be a buy limit. I know it's a little bit confusing, but that's why I'm saying that part really slow. Now, if you want to go in the direction, so when it comes to buy limits and sell limits, you're basically getting triggered based off of you predicting a reversal in a sense. Okay, so like if you feel like price is gonna reverse from that level, you're gonna use a buy limit or a sell limit, and then you just have to use the opposite one for your TPs and take profits. I'm sorry if I didn't explain that well, but that's just kind of what it is. You gotta like you're gonna have to get used to it. You're gonna have to play around with the platforms and things like that. Now as far as a buy stop or a sell stop, if I feel like price is going to go in the direction that I want it to, I would put a buy limit. So like if I thought that price was gonna buy from here, like let's say I was like, okay, if price breaks this wick, I want to get into buys, right? So I want to get into buys. I want to have my sell stop down here, or I mean, I want to have my stop loss down here, and I want to have my take profit up here, right? For example, after this candle, you would have gotten triggered in with a buy stop, okay? And now you would be in profit. And then right here, once you hit your TP, you would either close using market execution. So again, you would just click the button, whether it's an X or a cancel order sign, whatever it is, you would either just click the X or and you do it manually, or you could have a sell limit. So a buy stop and then a sell limit. And then your stop loss, if it was like somewhere down here, that would be a sell stop. So the stops go in like, yeah, let me just say it like that. I don't want to start getting more confusing because it is a little bit confusing. Like I said, when I started trading futures, I was a little bit confused, but like, again, most of the time I market execute anyway, so it really doesn't matter. Okay, so now essentially that's pretty much it from this video. So I hope that you guys took notes. I hope that it made sense. I tried to take it very slow and show you guys examples as well. I think I did go a little bit longer than I expected to. But as far as like understanding some basic knowledge and stuff like that, you guys should already understand most of this stuff. But if you don't, then now you'll know a little bit of like what we're talking about as far, so it doesn't sound as much of a foreign language to you. Okay, so yeah, so in the next video, I do have a few videos planned up for you guys, so I will be posting some more content for you guys, and hopefully you guys enjoyed the video. Hopefully you guys learned something. So I will see you guys soon in the next video, or actually you'll see me, but you already know. You dig?